All right, let's dive right in. Today, we're going to break down a really powerful scalping strategy that's all about one thing, making quick, small, and consistent profits. If you're a retail trader who's just tired of getting beaten up by the market, then you're going to want to stick around for this.
So here's the deal. If you're trading with a smaller account, you know the problem with traditional intraday trading, right? You hold a position for hours, only to get stuck in those sideways, choppy markets, which, let's be honest, is where the market is 80 to 90% of the time. It just leads to frustrating losses. But that's where scalping comes in as a game changer. You get in, you get out, and you capture those small moves with very little risk. So what exactly is scalping? It's actually super simple. It means you're in a trade for a very, very short amount of time. We're talking minutes, maybe even just a few seconds. The whole goal is to just grab a quick profit and then you're out. There's none of that hold and hope stuff. It is all about speed and precision.
Okay, so let's get into the why. Why does this approach actually work so well, especially for those of us who don't have a giant trading account to play with? This is what we call the scalper's edge. You know, the single biggest killer for intraday traders with small accounts? It's risk. It's so easy to get caught in a choppy, directionless market and just slowly bleed your account dry. Or worse, one big loss can completely wipe out weeks of hard-earned gains. And this is exactly what scalping helps you avoid. It's all about focusing on those high-probability moments while keeping any potential losses incredibly small.
And you know what the best part is? It is so simple. You're not going to need a screen that looks like a space shuttle cockpit with a million different indicators. Nope. Let's look at the only two tools you'll need and how to get them set up. Seriously? Setting this up is a piece of cake. Just go to your favorite charting platform, find your indicators, and add the moving average exponential. You'll see it as EMA. Add that to your chart twice. Then you just click on the settings for each one, change one length to 9 and the other to 15. And that's literally it. You're set. Your chart is ready to go.
So why these two numbers, 9 and 15? Well, think of the 9 EMA as your sprinter. It sticks super close to the price and shows you what's happening right now. The 15 EMA is its partner, just a little bit slower, giving you a better sense of the overall short-term trend. When they're working together in sync, they're basically your perfect momentum detector.
Okay, pay close attention here, because this next part is completely non-negotiable. You can have the best setup in the world, but without rules, it's useless. So let's cover the exact conditions for when you should take a trade, and, just as important, when you should keep your hands in your pockets. This right here, this is what you're looking for. On the left, you see the EMAs are separated, they're angled, and the market is clearly moving. That is the only environment we trade in. The messy, tangled up chart on the right, we avoid that like the plague. Trust me. Trying to trade in a choppy market is the fastest way to lose money with this strategy. And hey, let's make this super clear, no guesswork involved. We need to see a nice, sharp angle on those EMAs. Think 30 degrees or more. That angle is your confirmation that there's real momentum behind the move. If it's looking kind of flat or the angle's less than that, it's a no-go. We just wait for a better setup. Simple as that. Now, your entry can be perfect, but if you pick the wrong tool for the job, it's all for nothing. When we're scalping, we are always looking at in-the-money or ITM options. Why? It's all about something called delta. ITM options have a higher delta, which just means their price moves more for every little tick in the market. Those out-of-the-money options might look tempting because they're cheap, but they won't move enough to give you a profit on these quick scalps.
Okay, charts are ready, rules are clear. Now for the fun part. Let's talk about pulling the trigger. Here is the exact step-by-step plan for getting into and out of your trades.
Now, a super important point. We don't just blindly buy the second the price touches the EMAs. We need to wait for confirmation. We need the price to tell us it's ready to go. And these 3 candle patterns are our signals. A pin bar, which shows a rejection of lower prices, a power candle with a big, strong body, or an engulfing candle that just completely swallows the one before it. So let's walk through it step by step. It's a simple 4-part plan. 1, you see one of our signal candles form right at the EMAs in a nice uptrend. 2, you place your buy order just a tick above the high of that candle. 3, your safety net, your stop loss, goes right below the low of that same candle. And 4, you aim for a profit that's twice what you're risking. That sweet 1-to-2 risk-to-reward ratio. And what about selling or shorting the market? Well, it's even easier. You just flip everything upside down. In a strong downtrend, you look for the bearish versions of those same candles touching the EMAs.
You enter below the low, stop loss goes above the high, and you're still targeting that 1 to 2 risk reward. It's perfectly symmetrical. Okay, everything we've talked about so far gives you a solid, profitable strategy. For sure. But what if I told you there's one final check, one secret ingredient that can potentially crank the accuracy of this thing all the way up to 90%? So, what is it? What's this one game-changing rule that can help you filter out the bad trades and really focus on the A-plus setups? What separates the good trades from the great ones? The magic word here is confluence. If you're trading in the Indian markets, for example, you must never, ever trade Nifty or Bank Nifty in isolation. You need both charts open right next to each other. The absolute best, highest probability trades happen when both of these big players are moving in the same direction. Let me show you exactly what I mean. Let's say you get a picture-perfect buy signal on Nifty. Before you jump in, you glance over at Bank Nifty, and you see it's also bouncing off a key support level. That's a green light. That's a high-confidence trade. But what if you get that same perfect signal on Nifty, and you look over and Bank Nifty is running straight into a major resistance level? That disagreement between the two, that's a massive red flag. You just walk away. When you boil it all down, it comes back to managing your risk. In the words of the person who created the strategy, the most plus point is that our stop loss is very small. And that is everything. It means you're never risking a huge chunk of your account on any one trade. You can be wrong, take a tiny loss, shake it off, and you're right back in the game, ready for the next setup with a clear head. So look, the strategy itself, it's simple, it's mechanical, it's powerful. But here's the tough part. Knowing the rules is easy. Having the rock-solid discipline to follow them every single time, especially that final confluence check, well, that's the real challenge. So the real question isn't whether the strategy works. It's, are you ready to put in the time, to back test it, and to build the discipline to make it your own?